The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. From improving emergency response times to protecting against cyber attacks, local, state, and federal governments are innovating with Google AI. This is a new era of American innovation. Find out more at g.co/American Innovation.
Reality radio for a really great future. We're talking real money.
All right, let's get the housekeeping stuff out of the way right now. Let's do it. Let's give the phone number out because that's the key to getting your questions about money answered by two old guys who've done this for a long time and are going to give you answers that you may not like, but you can probably figure are the truth, at least the truth as far as we know. And that number is 855-935-TALK, 855-935-8255. Now, in case you just joined us, the show's Talking Real Money, and the two old guys go by the name of Tom Cock over there in the Washington studio and Don McDonald here in Florida. We've both been doing like radio shows and podcasts and, in Tom's case, even TV shows about money for several decades. So we kind of know what we're talking about. And we love talking to you. 855-935-TALK, 855-935-8255. Did you know we love the concept of a balanced portfolio, of having some money in stocks, some money in bonds, probably a little more in stocks than in bonds because they tend to make more money. But the main reason we do it is because of its diversification effect, the fact that it gives you some safety. It's not absolute safety. It's more like, it's more like wearing a seatbelt in the car. And when you get in a wreck, you're more likely to walk away if you're wearing a seatbelt. That's what a balanced fund is. But lately, in the near past, the 60-40 portfolio, the balanced portfolio, has had a bad, and boy, there are articles all over the place about this, has had a bad stretch.
Well, it's had a horrible stretch, and you go back to 2022 where bonds got crushed, right? I mean, the part of your portfolio you don't expect to see go down.
That was the part that was supposed to save us.
Yeah, exactly, because stocks went down too. So it was really bad. In fact, helped by that, this is the only 5 years so far that the all stock portfolio did not go down as much as the balanced portfolio, which is exact opposite of what you would expect. But I love this article because it goes back 150 years.
Yeah, this is from Morningstar, which has access to great research.
Apparently so.
Yeah, it goes back 150. Yeah. I have not seen many.
I don't know how they did that. Yeah, I don't either.
Many.
They did.
I didn't even know I guess they had bonds. Okay, you have bonds and you had stocks.
Yeah.
So they just built their own 60-40 portfolio. Sure.
Yeah. 60% stocks, 40% bonds. So you get 150 years of research. And what it shows to me, now, you left out one important part of the reason I like balance. I like balance because generally people will stick with it better than they will when you have a concentrated or all stock portfolio or something else, because things blow up more and they give up. And we know that. We've seen it over and over and over. A balanced portfolio, you would have had 11 bear markets in this period of time with all stocks. 19 bear markets. That's where you get 20% decline.
Scared more often. That's one of them.
Yep. Now you made less money. You pointed out.
In some markets, in most of those bear markets, you would have done better. You would have lost less with a 60-40 portfolio, right?
Quite a bit less. In fact, in the Great Depression, all stock down 79%, the 60-40 down 52%. So that's a pretty big difference.
But that's still, both of them are really scary.
Yeah, they are. Okay, but how about the lost decade? That wasn't that long ago, the 2000s, right? All stock portfolio, worst decline, down 54%. The 60-40, worst part, down 24%. Now you're starting to get in the range where people can hang in there.
Better, yeah, that's feeling better. 50% is kind of scary.
The trade-off has been less money. Now according to their numbers, what is it, $1 in 1870, which most people probably still could have afforded. Yeah, $1 in 1870. The all stock portfolio would have grown to $30,300 by the end of May of 2025. A lot of money. But the 60-40-year $1 only grew to about 4,000. So you made a lot less money in that period of time. So the trade-offs are there. I just think for most people, having, as you correctly pointed out, stocks and bonds are completely different types of securities. That's diversification. That's what you want. It will allow you to stick with things longer. And you can, and by the way, the other part of bonds, which has not, and they talk about this 5-year period. First of all, decade ain't over yet. So let's let it play out. And I think we're getting into a more normalized bond market. And if you get a cut in rates,
hey,
you're going to get some bond prices.
I know. Nothing.
The smart people we listened to just said last week we can expect 1.25% decline by next August.
They're predicting because we keep asking them.
That's true. So, but the bonds should provide for people in retirement the income they need even when stocks go down. That's another huge point.
So basically, the message is 60-40 isn't perfect. It's not. It's not meant to be. It's just a way to save yourself some grief and to keep you from panicking. 855-935-TALK.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Apella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Apella is an SEC-registered investment advisor. See ApellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
It's a great day to talk about your money, to get answers to your questions, to try to solve some of the investment issues you have, problems and concerns, to find a way to do things a little bit better. We're here for you. 855-935-TALK is our phone number, 855-935-8255. I'm Don McDonald. Over there is Tom Cock. And thank you for being right there where you are. Let's go over to Bothell, Washington right now. And John, you're on. Welcome to the show.
I have a question regarding a comment I thought I heard regarding fixed indexed annuities. I can't recall what you said that was bad about a fixed indexed annuity.
What's good about them?
Actually, it'd be the other way around. Yeah, what we said that would be positive about them.
Yeah. I can't find a single good thing to say.
Me, but my question is, what is it that you find bad about a fixed indexed annuity?
You want to start, or do you want me to?
I think this is yours, partner. So
okay.
You do it better than I do.
Let's start. Let's start with the begin. Let's start at the very beginning. It's a very good place to start. Let's start with the pitch. The pitch is get the returns of the market with none of the risk. Okay, they're starting out with a lie. That's an absolute, unadulterated lie. You don't get the returns of the market. You get the returns of a market up to a maximum and probably only a percentage of it. And it's usually an index that is designed specifically or chosen specifically by the insurance company to limit the amount of return that index can offer. Truly made-up indexes and indexes you can't buy. That's one. Two, there is a horrible commission charge. I've seen them in the disclosure documents as high as 12%. Those commissions are, as far as I can tell, never disclosed to the prospects. How about the surrender charge? Those I've seen as high as, again, 12% over 12 years. Are they disclosed? Never verbally. Sure, they're in a disclosure document that no one ever reads. It would be, I wouldn't have a problem with them if it was pitched, if they were pitched to people as, here's a way to make 3 to 5%. You're only going to get a portion of the market's return. You're not going to get all of the market's return. And the risk is pretty darn low because it's an insurance company and I get a big fat commission. If the people selling them said those things, I wouldn't have as many issues with them.
And I'll add one more. I mean, that we see regularly, in addition to all those promises that people think they hear, would be the lack of liquidity, because most people in retirement either need regular liquidity or they run into a situation where they need to get their money, and you really can't without giving up a lot of it with the surrender charge.
Okay. I'm still here. That's a lot of information. But going back to what I think I know, and that is, of course, there's a cap on the growth.
Yeah.
And I was looking into had a 0.25% charge for placement, and so it wasn't that high, and I'm not aware of what the commission was.
That's because they don't disclose the commission.
But let me please finish my question.
No, absolutely.
My question is, what do you propose that accomplishes the following? Let's say you're only interested in a 5% return. Mm-hmm. It doesn't really have to be that much. The important thing is it does participate in the S&P to some degree, but the key is that there is no loss to the value of the annuity as far as the pot of money goes. What's an alternative to that? And I'm sincere. I'm confused.
I get it. I get it. And it would be great if there was an alternative. If such a magical product existed, but the reality is what you get is always less than is alluded to. In every pitch I've ever heard, I've ever read, I've gone to the steak dinners, I have read thousands of pages of disclosure documents, thousands of pages, literally. I can. It is not the product they're making it appear to be. You're not likely. As a matter of fact, historically, the returns have been 3.5% to 4% per year on average. That means in some years you might get 5 or 6. In other years you get 0. In bad years you get a 0 return.
Yeah, and just to finish the thought here, and thank you, John, by the way, for the call and for your comments, because I think it's a worthy discussion. The other part is the guarantee, because you said, Matt, it sound like this is a guarantee. Well, it's a guarantee between you. It's an insurance contract, you and the insurance company. That to me, okay, there have been times when insurance companies have not been able to meet their obligations. See many of them, including AIG, we all chipped in to help make sure things are okay. So you're right. Is there an aspect of, well, I give you the money, I get this part back. We just don't think the trade-offs are nearly what they're stated, nor at all what people are expecting. I'll put it that way.
If your goal is to get a decent return without any downside risk whatsoever, the only thing I can come up with that I know works, because I do it myself, is a ladder of certificates of deposit. A 5 or even a 10-year ladder of CDs that is giving me currently, for a portion of my fixed income portfolio, an average annual return of about 4.4% based on the bonds I have, or the CDs I have. And if I hold them to maturity, I am guaranteed to get my money. That is the only thing I can think of that's giving me all of these things that I want. But the insurance companies know that you want more than that. You want the return of the stock market. And by the way, the commission comes out of the difference between what they pay you and what they make on the money. It's not a fee built in, but it is a big fat check that goes to the person selling the product. And if they're truly acting in a client's best interest, they're required to disclose that, but they don't do it.
My mind is going around in circles. You've answered my question. From what I understand and from what you told me, they don't correlate. However, there's an excellent chance I could be wrong, because I'm pretty darn sure I'm not as smart as you guys. I will have to do some more research before I put any money into that product.
Please do. And by the way, John, there is the Financial Industry Regulatory Authority, the people who oversee the brokers and their licensing, they have an investor alert on their website. They don't put up investor alerts very often, and they have an investor alert against indexed annuities. You can also just type in equity indexed annuities almost anywhere and look at the major publications, the money magazines, the Forbes, the Wall Street Journals, the Barron's, and the like. And you're not going to find anybody, unless it's an article written by an insurance salesman, and they do a lot of those, so be wary of those. You're not going to find any legitimate journalist who says these are great products.
You know, and I would add, by the way, in addition to the lack of liquidity, other things, we're about simplicity. This is a very complicated product, and I don't want to be confused when I hand my money to somebody. I want to know how it's being handled.
855-935-TALK is our phone number. Give us a call. It's free and it's easy and it's almost anything money.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
It's the money matters that really matter in your life. And by the way, if there was something good about indexed annuities, if they were good products, we would give them to our clients.
Yeah.
We would put them in if we thought these were really good, but they're not. They're the antithesis of what we believe in. They're opaque, not transparent. They're misleading.
Expensive.
They're
if
expensive.
You really look at them. Yep.
They're illiquid. There's complex.
Commissions.
It's just all of the things. Oh, you know what we should do?
Well, I've got something to talk about. But
hold on.
ahead.
No, I've got a caller who wants to talk about them.
Okay.
So let's continue, shall we? Let's go to Port Orchard, Washington. And Charles, welcome to the show.
Yeah, my question is, how do you feel about a financial planner that sells an annuity product and then tries to manage it too at a fee of 0.5% per year?
Well, okay, if they're getting if they're getting a fee for managing the annuity, then they're a registered investment advisor, and therefore required to act in their client's best interest. And I cannot imagine anyone in a regulatory position or a judge saying that an indexed annuity is a best interest product.
Well, I want to make sure we answer your question directly, Charles. The answer would be we don't think much of them. That's not somebody we think we should hire. No.
Okay. And the question would be a fixed annuity and not an indexed annuity.
Okay, they shouldn't be charging a fee for managing wait, is it an immediate annuity or a fixed rate annuity?
It's a fixed 5-year annuity.
Yeah, I don't know that they should be. You should be paying.
Okay,
them
it's not
for
as
that.
This one is not as cut and dried. You could make an argument that it was the right product for a client. You could make that argument. It would be, I think, it'd be a little squishy.
Okay. Yeah, and annuities themselves. Yeah, the insurance companies can be good, but they can go bankrupt and or go into rehabilitation, and you can't get your money very easily. But at least in the state of Washington, you do have some insurance against it.
But bear in mind, too, if AIG had gone under, most of the state insurance pools would have run out of money. They would not have had enough money. And remember, many years ago, a couple of decades ago, we had a California company, a very big one, Executive Life, go belly up. And many of its clients, it took decades for them to get their money back. It was a very slow process.
And I will say this, Charles, and thank you for your call. Most people buy annuities because they hear the guarantee. Mm-hmm. Most people, like, I get a guarantee amount, blah, blah, blah. They don't think about all these other factors we just mentioned. And they already have if you get Social Security, guess what? That's an annuity. You have a pension. Guess what? That's an annuity. You have savings. You can create your own annuity at a much lower cost than giving all the money to somebody else and having them send it back to you with less. That's the reason we don't like the product.
I understand. Now, the bottom line then is you don't feel like a financial planner as a fiduciary should be charging a management fee.
Yep, you're cutting out on us a little bit, Charles. Sorry, but yes, you've hit it right on the head. We would not, in our capacity as a fiduciary firm, we would not sell someone a fixed annuity and charge a fee to manage it.
No.
I mean, we might suggest, I don't think we would even do that. That
Nope.
somebody.
I don't think so.
We might an immediate
said,
annuity, maybe, but not a fixed annuity, because there are better ways to do it without having the insurance company.
Well, you already mentioned one. The CD ladder will give you the income you need. There's a guaranteed aspect of that. So.
Charles, we appreciate your question, and I want to be fair, but I have a hard time being fair when you've got a middleman, woman, company in the midst of all this who is sucking out such mammoth profits and not really disclosing how much it costs the client. They hide everything away. It's so opaque. I hate opacity.
And if you ask them, they'll tell the client, "Oh, you don't pay that. The company pays me," which is an outrageous statement. Really?
Well, I mean, you pay it. The problem is it's not. When you buy an ETF, you know what you're paying. When you buy a mutual fund, even one with a commission, it's in the prospectus. You know what you're paying. Insurance doesn't have that same kind of requirement.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
To Charles' question, and many of you out there, I want to reiterate a little bit before we move on our thinking about the annuity business. First, insurance, we don't feel that insurance and investments should be commingled.
They should be separate.
They should be separate.
Yep.
We do believe there is occasionally a possible place in a portfolio for a certain type of person. However, it's rare. So real quickly, I just want to go from worst, just on the main types of annuities that are out there.
I want to finish that thought, though, because it generally it's only what we call an immediate annuity. You give the money to somebody, they pay you back part of it with a small amount of interest. Mm-hmm. And that could work a couple ways. It could put you on a budget, a diet, right? And it could also make sure you're going to have the money you need for a long period of time. So there's a guaranteed aspect of that's okay.
Yeah, there are downsides, but I just want to list them real quickly, just in worst to best order.
Okay, sure, why not?
Fixed, indexed, or equity indexed annuities. They're, in my opinion, they're the most misleading, the most complicated,
oversold.
The most horribly sold. Yeah. Number 2, variable annuities.
They still sell those things?
Yeah, they still and they sell them in 403Bs all the time. And what they do is they give you a benefit that you don't need because you already get it. And even if you don't get it, and they use them in a regular account, then the benefit can be gotten other ways with less tax, with a smaller tax hit. So badly sold. Next one, fixed income annuities that provide you a fixed rate of return over a certain period of time. It may be a slightly higher income than you can get from other fixed income vehicles, but there's a reason, because they're investing in riskier investments to pay you what they're paying you. Finally, the best one, the only one that we really could at times say, yes, this one makes sense, as Tom just said, the immediate annuity.
Yeah, which for some people, yeah, sure, that makes sense. Now, again, we don't use them because we think we can build the portfolio, design the income, et cetera, and do it at a lower cost. But sure.
Right. I mean, that's the thing, is that in a vacuum where there is no help being provided whatsoever, they may fit even more purposes. Maybe. But generally speaking, they're not used by fiduciary investment advisors.
No, I think
that's
fair.
Pretty much the rule. Yeah. They are used by commissioned salespeople. And it used to be there was a pretty sharp line between the commissioned people and the fiduciaries. The SEC has allowed that line to be blurred, erased a little bit. They're now allowing people to say things that they couldn't say a while ago because we're seeing a general decline in the amount of consumer protection you get in the investment industry. It is declining dramatically. You're getting less help, not more.
Yeah, I would say and that whole area is grayer than the Seattle skyline come November. It literally is. There's no differentiation at all. Thank you.
Yeah.
Worked all week on that. So.
Okay, good work. So generally speaking, we think that they are lazy products. They're often an easy sell because they're regulated by the insurance industry, except for variable annuities, which have some other registration. But they're generally sold to you. They just aren't the kind of things that somebody who's trying to do the best job for you would recommend. Really. 855-935-TALK. We've got lines open for you right now. A lot of time left in the program. We want to help you manage your money better, okay?
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
It is the show about your dough and about your life, because we're trying to make it easier to manage money so you end up with more of your money, because who worked for it? Oh, yeah, that was you. That was you, not your insurance agent. 855-935-TALK is our phone number. That's 855-935-8255. And let's go to we went to San Antonio last hour, and now we're going to New York City. Brian, welcome to Talking Real Money.
Hey, Tom and Don. Love the content, love the show.
Thank you.
Yes, I'm from New York City, but I'm sweltering. I'm sweltering down in Florida right now.
You're in my neck of the woods.
Oh, man, that's a neck to avoid this time of year. Let me tell you that much. Whew, no way.
It is. Visiting family. So the age-old question, to pre-tax it or to Roth it, but everybody's situation is a little different, so let's go to So Ed Slott will tell you, I guess, Roth it all the way no matter what. So my wife and I, we are in the 24% bracket, teetering on the 32% bracket, and I am a New York City public school teacher, so there's a pension coming in about 5 years. That's my plan. And I can also do, I can max out a 403B, and I can max out a 457. And I can also max out a backdoor Roth IRA. We do all these pre-taxes to keep in that 24% bracket. Now, the 457 has a Roth and a pre-tax. In the previous years, I had some Roth, but I've been going pre-tax with the 457, and I'm maxing that out. The 403B, this is what's interesting, and this is what I think is kind of pathetic. I don't want to talk bad about the system, but my 403B, which is probably the first or second biggest plan in the country, still does not have a Roth. It's only starting the Roth option in 2026 because of that new law. I believe that age 50 catch-ups have to go to a Roth.
Good Lord.
So I said, okay, but right. So everything is pre-tax. And then reading into it further, it seems like they're only allowing future contributions to go to the Roth. They are not allowing in-plan conversions. So you immediately say, no problem, after I retire, move it out to an IRA. But I don't want to do that for a couple of reasons. First of all, I'm going to probably apply the rule of 55 with the 403B, and the 457 doesn't have a 10% penalty. So I'm going to keep those in there at least till 60 years old. But the 403B, the one thing it has going for it, it has a guaranteed 7% fixed, no fees. So in my Roth IRA and my 457, I'm all equities, and I have no bond allocation. I don't think I need one. So if they don't eventually allow the in-plan conversion, I'm never going to want to roll over that 403B to an IRA because I got that 7% fixed.
Yeah.
So now it comes back to that question. If we're teetering on the 32% bracket, do I continue to do pre-tax or start going Roth? Now, I will be, this is the year I turn 50, so the age, and I think I'm right at that salary limit where I will have to do the catch-up contributions in both accounts to the Roth.
Yeah, that will be a requirement in 2026. They had planned it 2025, but I think they pushed it back a year. So you're right there. Here's my question to you, because you mentioned that you're going to get a pension, and then you're also going to do the amount you take out of the 401k every year. And then at some point you'll be adding in social. I want to know what bracket you believe you're going to be in when all of those things are paying you, because I would compare that to where I am today.
That's a great
Then
idea.
I would make a decision rather than just saying, well, what makes Ed Slott it's very easy for people to get up and say, just put it all in Roth because in 20 years you're going to love me, and then go ahead and pay a 30-year income today in taxes. That's a lot.
Yes. Let's factor this in. Yes, I'm a New York City resident, but in five-ish years, when I'm eligible to retire, I think we're heading down to Florida. What doesn't Florida have? No state income tax.
Yep.
So if I could start doing big Roth conversions between, say, the ages of 55, delay Social Security as late as possible, maybe start withdrawing from that 403B a little bit, or doing conversions before Medicare premium. I have 75. I think 75 for me will be the RMD requirement. So I have 20 years to do conversions, and especially those first beginning years before Social Security and before Medicare premiums. I think I have a lot of wiggle room to just stay pre-tax now while employed, and then if I go at 55, and my wife, who's 50, she's not working a day longer than me, so I don't know. I just feel like we should just continue to pre-tax it.
Well, it sounds, and this is really the simplest formula. Do you believe that you got more income, taxable income coming in today than you are likely to have whenever it is that you retire and start collecting pensions and Social Security? Then keep going with the tax deduction for today, and then do Roth conversions, or just pay the taxes later.
That's what I wanted to hear, because I don't.
Yeah.
So
I mean, and you could, if you wanted. Yeah. I'm sorry, Brian.
It's not that
if
simple.
If you wanted to, it doesn't have to be binary, right? You could split the baby. I think you said you're doing backdoor Roths anyway, so you are putting some money in post-tax. You already know in 2026 the catch-up, which I think is what, 7,500 or whatever it is, that amount of money, that's going to go in the Roth starting next year. So you're going to be building up that bucket a bit too. You have the guarantee of the pension, Social Security. I think things are looking pretty good for you. I wouldn't overthink it.
I think you're thinking about it the right way. There is no absolute. It's one of these it depends scenarios again, because it truly does depend on a lot of things we don't know. We can't know. We're just guessing about. But right now you've got the bird in the hand. It is in the hand. You are keeping your bracket from creeping up a lot.
Yeah,
to 32.
That's a big move.
That's a huge jump. That's a 12% jump. And then you and then there's New York
10?
State and city.
Yeah, it gets to be. I mean, half your money going to somebody else.
I think you're very wise, except for the part about being in Florida in the summer. But I'm there too, so what can I say?
Maybe we could get you to buy Don's place. We'll move him out here, because I got a little home for him in Duval. It'd be perfect. So.
Home.
One more thing about the mechanics of these. One more thing.
Yeah.
If you guys have one more minute about the mechanics of these accounts with the 2026 mandatory Roth catch-up, they haven't given us any guidelines. In other words, if I take if I'm maxing it out, 7,500 is about 24% of the contributions that I'm eligible for. So you set it up at the beginning of the year, percentage Roth, percentage pre-tax. So if I set it up that way in anticipation of this new law, are they all of a sudden going to? Because I just want to do the amount that I'm required to, the 7,500. Are these accounts going to say, okay, he set it up for a certain amount of pre-tax. Oh, he made it to the 23,500. Now it's going to go Roth all the way. Like, they haven't given any guidelines on these accounts.
Yeah, I don't think we could help. I don't think we could help you there, because that's going to be a plan by plan. The administrators are going to figure that out. I couldn't help you there. I mean, because we're in the same spot. We're going to both be putting money in post-tax, and I'd prefer to have it all in pre-tax. So. Sorry, we can't be
And
more specific there. That's hard to know.
It's so new. I think everybody's kind of running around.
Yeah, feeling their way.
Yeah, seeking an answer.
Right, and just the fact that, like I said, my 403, it's a huge, huge plan. New York, the whole
New York City. Well, the New York City plan is also you get the New York State plan, which is even bigger.
Well, that's for the 457. The New York
for the
City
457.
403B is actually separate than the New York State. But for the 457 is also a city one separate. But it still boggles my mind why my 403B still has no Roth, and it's been an option for 20 years. Or 15 years. So
they still got horses running the subway, or do they move that to a different form of method of moving the cars around? I mean, what is this? Come on.
They might be going back to that. You never know.
Well, as long as they keep the water out of it, I guess it'll be
horses
okay,
can at least swim. All right, thanks so much. We appreciate it. Stay cool. Stay under air. That's what I'm doing. I don't go outside. Summers here are like winters up north. You just don't go outside. Why am I going to give the number? We're coming up on the final break. Hang out.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Every flippin' year, I get a year older. Ask my wife.
You don't like
Ask
it.
my wife. I don't like it. I hate I used to be, when I was a kid, I loved birthdays. It meant all the tacos I could eat.
I know.
And presents. Now it just means I'm going to be dead sooner.
Well, and they call you elderly, and you got to take a pill to remember to take the other pills. And let's face it, you're not getting to be a better driver either.
I don't think there's anything good about it.
No, there is.
I just had one 3 weeks ago, and I didn't get anything good about it.
Because you didn't do what this guy did. He spent 15 hours sifting through all the things he can get for free on his birthday. I love this. Now, I wouldn't do this either, but did you know, for example, that you can go to Red Robin and get a free burger on your birthday?
Do I get to the bottomless fries with that? I bet I do. Crumble cookie. You can get a free, guess what, cookie. A smoothie from Jamba Juice, a drink from Starbucks, a cookie from Subway. We're getting a message. Jersey Mike's also gives you Anyway, this guy ran around and he got like 40 freebies in one day. He just said, I'm taking my birthday off and I'm running around getting all this. I didn't know you could do all this stuff. I get notices of them, but it requires that you actually go somewhere and do something.
Exactly. Yeah, you got to do it. By the way, Denny's says they've had basically a 30% increase in redemptions of its birthday freebie in 2024. 300,000 people went in on their birthday for the free Grand Slam, which I don't know how they felt on the day after their birthday. Anyway, I didn't even go, but I'm sorry. But I mean, it shows you the lengths people will go to for free stuff, because free is still that word that people, they love free. I mean, free is such a great thing.
I mean, for example, I got free popcorn at AMC theaters, and I'm going,
they mentioned
I gotta go to a movie.
I know. Panera does pastries. Panda Express, you get a small entree. Ben & Jerry's gives you a scoop of ice cream. Burger King gives you a Whopper. Now, I don't know if I'd have a Whopper and a Red Robin burger the same day. That sounds a bit excessive, I think, but there you go. You could do that. Taco Bell gives all this stuff.
I'm just checking to see if
there's a woman, by the way, who did 61 deals. She spread it out over 30 days. She said some people will allow you to, come in on not exactly on the birthday, but within a period of time. She says it was a full-time job for about a week.
Yeah. I'm looking at my Panera app, and I don't have anything free.
Yeah. Sorry
for my
about that.
birthday, but maybe it's it's 3 weeks past.
Maybe you're so old they don't expect you to be able to come there and get the sandwich.
Or maybe they think I'm dead. Maybe they just assume he's dead. He's not. He hasn't come in for a sandwich in a while. He must be dead.
That's a good point. That's a good point. So
all right,
there you go. Take advantage of all that stuff.
Thanks for sharing all that money-making information. Money saving. Well, a penny saved is a penny earned.
That's what the great Benjamin Franklin once said, allegedly. So.
About whom I'm reading in the book you recommended to me.
That book never ends. That book just goes on and on. What page are you on, by the way?
I'm on the first book. I'm on the first book, not the second.
Oh, you're still on the first one. The first book. For second one's just 885 pages.
I have a show. No, you got to get No, you have to get PBS. And you know what? We all want.
I think it's pretty easy to get PBS now.
You get the PBS app. You got to pay. You got to give them some money. You got to give them a donation.
I think we have that. Yeah.
All right.
And what's the show?
Mr. Bates versus the Post Office. It's so good. It is a really compelling story.
Mr. Bates versus the post office.
You got to watch it. It's about the British Postal Service.
Can we say it?
And it's
really
money-oriented. And it's money-oriented.
It really delivers.
No, they really didn't deliver. We got to go, though. Go to TalkingRealMoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.
This episode is brought to you by Bluehost. You might not be a tech genius, but you want the website for your business to crush it. Thankfully, Bluehost makes it easy. Customized, optimized, and monetized. Everything exactly how you want with AI. Your site can be up within minutes, and the search engine tools even help you get more site visitors. Whatever your passion project is, set it up with Bluehost. With their 30-day money-back guarantee, what have you got to lose? Head to Bluehost.com to start now.